In a surprise move, the RBI's MPC announced in its monetary policy review that it would keep its repo and reverse repo rates unchanged at 4% and 3.35%. The MPC has also decided to continue with its accommodative stance to revive and sustain growth on a durable basis and to dampen the impact of COVID-19 on the economy.
The RBI surprised money market participants by keeping the repo rate at which the RBI lends money to commercial banks, unchanged at 4% for the 10th time in a row. These decisions are in line with the aim of achieving a medium-term target for CPI inflation while supporting growth of the economy. Many experts in the market were expecting a hike in the reverse repo rate. As such, the decision to maintain status quo has come as a surprise. Given other global factors, the decision to prioritize growth over inflation reveals RBI's confidence that the country can remain isolated from global monetary trends.
The marginal standing facility, that is MSF rate and bank rate, remain unchanged at 4.25%. The demand for contact-intensive services is still muted. Going forward, positive impulses for quickening the pace of recovery emanate from buoyant Rabi prospects, robust export demand, accommodative monetary and liquidity conditions, improving credit offtake, and the continued push on capital expenditure and infrastructure in the Union Budget 22-23.
Repo and reverse repo rates remain unchanged at 4% and 3.35% respectively. RBI maintains accommodative stance. Continued policy support warranted for durable and broad-based recovery. GDP for FY23 projected at 7.8%. RBI Governor Shaktikanta Das also projected the country's GDP for FY23 to be 7.8%. Das also added that every effort was made to ensure that there was limited disruption to economic activity, saying that while inflation, especially CPI, did rise, it was along expected lines. Core inflation remains elevated while rising headline inflation is expected to peak in Q4 of FY22 before moderating in the second half of FY23. CPI inflation is expected to moderate in the second half of FY23, allowing monetary policy to remain accommodative. Effort made to limit disruption to economic activity. Although CPI rose, it was along expected lines. Core inflation remains elevated. Headline inflation to peak by Q4 of FY22 before moderating by the second half of FY23. CPI inflation forecasted as 5.3% for FY22. FY23 CPI inflation forecasted at 4.5%. E-rupee digital voucher cap increased from Rs 10,000 to Rs 1 lakh and to be used more than once. Bureau Report, Goa 365.